Hey guys, welcome to today's session. I'm trying to sort out my light. As you can see, it's probably, you see how it's dancing different colors. I'm trying to get it to stop doing that. I forgot for the longest time. Now it's getting dark. I have like a massive lamp here and I just haven't used it for months and months and months. So as soon as though it's now basically pitch black in the UK and I'm like barely visible here, I need to try and make it so you can actually see me. Oh, yeah, that's a night light. But we don't want to be having a disco. I mean, maybe it's cool to have a disco like this. Let's see. That's probably the best we're gonna get. Maybe I'll switch on a light behind me as well because it is still pretty dark. There we are. That's better. That's absolutely fantastic. Guys, I hope we're all doing well. I'm just going to send the link into Discord, so bear with me for 2 seconds. I lost track of time. I was trying to figure out the light. Get shareable link. There we go. It's in the Discord. We are ready to rock and roll. Hola, Leo John. Unfortunately, today's session is in English. I can read and speak Spanish. However, I'm not going to embarrass myself on this session because my Spanish is specifically poor. Fun fact is I used to speak, I wouldn't say I was fluent in Spanish, but I used to speak very, very good Spanish. And then I basically took a back seat for a few years and was like, do I really need to, carry on? Lost everything. And now I work for a Spanish-based company, which is unfortunate because I've lost all of my Spanish. Welcome, guys. Can see people starting to come through, starting to come into the session now. Welcome, welcome. This light is doing my head in. I don't like that color. Let's change it to something more ambient. There we go. Let's just leave it as purple. Let's leave it as purple. Okay, guys. I don't have a specific agenda for today's session as per usual. I thought we could take a look over DarwinIA. We could take a look over the index because something interesting has happened specifically today with the index. So I was having a conversation internally yesterday with a couple of my colleagues, and we were talking about the index, and we were talking how we're literally breathing on 8 million AUM through Darwinex as the platform. Now, what's important to note with this is we also offer investment to larger clients through an AMC certificate, which is an actively managed certificate here in the UK. It's an alternative way to access the index. Now, investors who go through the AMC do not show up on this interface. Okay, so whilst this says 7.9 million, we're actually, unless I've missed, a few investors, there's a few 100,000 more AUM than what's shown on here. So we've actually surpassed 8 million, but of course it never feels official until the Darwinex website says 8 million, right? So we were talking about this, and I was saying how if we take a look, let's scale this into the 1 month. So this was where we were yesterday. It was actually a down month so far. And I was saying how investors are super, super predictable, right? As a lot of traders are as well, I guess. But we could predict. What on earth is that? I can see something. Oh, it's my bottle. I can see my bottle in the camera. I thought it was like something behind me. But investors are super predictable, right? And I said to them yesterday, to my team, I said, we probably won't see the 8 million mark until we've recovered, right? So if we just take a look at it again, from the 5-year perspective. So we'd had some consolidation up here after hitting new all-time highs, and then we started to trade lower. And as soon as we started to trade lower, what we saw was the AUM kind of froze at 7.8, 7.9 million. And we've been there for a couple of days, but I guarantee tomorrow, after today's recovery, well, it updates, the quote updates every night, right? So this morning we saw the updated quote from yesterday's trading. I can guarantee tomorrow we will probably skyrocket past 8 million because, and it goes against everything that you should have or should believe in as an investor, right? Is now it's at all-time highs. People go, I don't want to miss out now. It's recovered. It's done it. This is the biggest move. I spoke to Javi earlier on today, who is the CEO of Darwinex. and he heads up Darwinex Labs. So indexes have his baby, right? Darwinexes have his baby. And he said to me today, he said, this is the biggest daily increase in the index that he's ever seen. Okay, so the recovery today has been the biggest move in a single day that Javi has ever seen. And I agree with him. I mean, that massive surge there is just one day, or just one day's trading. He attributes that a lot to, and again, we're always super transparent about this stuff, about how things are, why things are. You know, we show you this track record. It's publicly available for people to see, but we also go one step further. You know, we'll kind of be open about what's happening on the back end and why the record shows the way it does. And the reason for this is simply because of gold, right? So we've had a lot of traders long gold. If I just load up TradingView, I should be able to see it. The leap with TradeStation has just started. Interesting. It's like a DARWINIA 2.0. Where are we? Gold. Oh, it's had a bit of a nasty drop off this afternoon. But if we just take a look on the daily, like we look at yesterday's daily candle. I mean, what was that from open to close? 2.85%. So when we have a concentrated group of traders who are all long and you see a candle like that, just know that probably signals a recovery. Not to the downside, because as you can probably imagine, with indices and commodities, specifically gold, not a lot of our traders like to go short. For whatever reason, I don't know. But this is the main reason or spur for the recovery that the index saw yesterday. Now, what's fantastic is we were seeing all-time highs being hit during this period for the index, which again, you know, a lot of our traders have long exposure to gold. But what was even more impressive than that was that during this period, we didn't see the index fall off. Okay, and that's a worry, because what we don't want is we don't want a gold 2.0, because investors may as well just buy into gold, right? Why would you invest into the index if it's just performing exactly the same as gold? However, during this period where gold was, you know, falling off a cliff, I mean, how much was it peak to trough? 11.3% drawdown from peak to trough there on gold. It was only it was I don't know, 2, 3, 4% perhaps on the index, because obviously it's a multi-strat fund. So there's hundreds of traders who are kind of self-hedging against that gold movement. So what's fantastic is we're capitalizing when the market is moving well, but we're also semi-protected when the market starts to move against us, which is super, super interesting. And we see it with indices as well, specifically the NASDAQ. And so I know I've explained this before, but anybody who missed it, this is why in these sessions I tend to, you know, explain things a second time, a third time, a 400th time, because there's sometimes, well, there's usually at least one person who doesn't know this information. So with the index, yes, we manage traders' risk on a trader by trader basis. So each trader is scaled down to 6.5% value at risk. However, what we also do on top of that, on top of managing the trader as an individual, is we group them together by various different variables. One of those variables being the assets that they trade. Again, the two assets that we have high exposure to, specifically during periods of high volatility, is gold and is NASDAQ. Gold is just, I don't understand the obsession with gold for a lot of retail traders. It's a violent asset. Yes, it moves well, and yes, I trade it. But it seems to be the favorite amongst traders who aren't necessarily profitable or aren't necessarily there yet. And I always struggle to understand why. Because it's one of the harder assets to trade, in my personal opinion. People may disagree. That's absolutely fine. That's the great thing about trading, is we don't have to agree. But I always think you're starting with a really difficult asset if you start trading gold, yet a load of beginners tend to do that, right? Anyway, getting off track. So what we do to hedge our exposure as a hedge fund is we monitor the value at risk at trader level to ensure no traders are getting over leveraged at any point, meaning that we're susceptible to, you know, that trader blowing up and then causing a massive drawdown on their own within the portfolio or within the multi-strat. But we also monitor the value at risk based on groups. So again, by asset. So if we're too far exposed to NASDAQ longs, to the point where the index is only moving up if NASDAQ is moving up, then what we would potentially do is take a look at our exposure from a trader perspective. Okay, how many traders are long on the NASDAQ? Do we need to cut any of these positions in terms of from an index perspective? Do we need to reduce some of our exposure to these traders, basically? Short term or long term, that may be. What you might find is we can make rotations with this at any time, okay, to monitor our exposure. So if we need to do a rotation for a couple of days, just because we're too exposed to a single asset, we can do that. And then we can reallocate that exposure back out after the volatility has gone, or after the exposure on the trader by trader level has gone. There's no point in us having 200 traders if 200 of them are all long NASDAQ. Defeats the object of running a multi-strat portfolio. We also look for different variables on top of that. So the type of strategy that you have. So the biggest one being, or the most special / unique one, is traders who martingale or grid. We don't have many of them in the index, but there are a few. And so what we do again is we measure their value at risk on a trader by trader basis, so that we know that those traders specifically aren't getting too over leveraged on their own or as an individual. But we would also measure the value at risk of all of the martingalers altogether. So if things start to get really bad and we see the value at risk of the group growing, we know that we need to either step involved, drop our allocation to those traders temporarily, or do whatever we need to do. We also have another portfolio specifically designed to tackle that problem. So if we are too exposed to the martingalers, and let's say their value at risk starts to get really, really out of whack and above levels that we're comfortable with, we have a martingale hedge. See if I can find it. Darwinex martingale hedge. Here we go. So this is the account where we hedge against that martingale. So you can see it's super, super infrequent, and it only trades, I don't know, maybe a few times per year, a couple of times per year. And what it waits for is it waits for the market to be really, really one-sided, and for martingale traders and grid traders to be really offside, to the point where they're being squeezed and their account's potentially going to be blown. And what this account will do is, when the trader is in really, really deep doo-doo and their drawdown is just getting exponentially bigger and their exposure is getting bigger, we then trade against that move. So let's say gold is moving higher and there's martingale is getting short, and their short exposure is growing exponentially. We would then start positioning long to counteract that additional short exposure, which you can see, I mean, over time, it makes money, right? And so, yeah, it's one of the interesting hedging mechanisms that we have in place with the index, which I always find super fascinating, but I don't really understand how it works on a deep technical level. I just know what the goal is and how it executes for that goal. But like I say, this only executes a few times per year, if that. Okay, welcome to the guys who are filtering in now. It seems fairly quiet today. Usually we've got quite a few active guys in the comments. So it seems that although it's quite a busy session today, it seems like there's not many people who are active. So if you have any questions as I go through anything in this session, please just feel free to drop a comment in the comment box. Fulfillment, how are we doing? Hi, Kieran. This has been on my mind lately. I think you mentioned it in the past that the more good traders you get, the better. Won't that dilute the available capital, reducing the performance fees? Yes and no. So in theory, yes, if we didn't scale the AUM. Okay, so if we stayed stagnant from now, then yeah, of course, over time, it's either going to dilute the capital or there's not going to be enough capital. The great thing with the index is we're the ones who are distributing that capital out. So we're able to allocate it to more traders. So that kind of counteracts a lot of the issues that we've seen in the past with capital all being allocated to one trader when there's plenty of good traders. The idea now, which it is happening at a fast pace, is kind of scaling both at the same time, traders and investors. Of course, you know, you might need to go through 50 traders to find one who is solid enough over a long horizon to become investable. You know, as much as I would love every single trader, especially every single Darwinex Zero trader, to be investable and to be a successful trader, the sad reality of this industry is that not a lot of people make it, and we're trying to give people the best opportunity to be able to make it. But yeah, that's I mean, I guess it's kind of our promise and our commitment to you guys as traders is we have to go out and raise capital, which we've done in the past. Of course, we have the DarwinIA allocation. So we have, I think, how much was it last month? I want to say 60 million in DarwinIA silver and another 30 million perhaps in gold. I could be way off with that. So don't quote me on that, but I'm sure. In fact, I might be able to find the exact figures, because I'd rather not put my foot in it. Let me see if I can find the email. Like I said, I'd rather get the exact figures so I know. I think I say it on the Darwinex emails. Yeah, so if I drag this over a second. So this was an email sent out last Friday. So I write these emails, just FYI, if you receive them. If you do receive them, I appreciate you reading them and you know, going through everything that I do, because I put a lot of effort into this. It takes a lot of my time. And, you know, it's always great to know that you guys are reading it. We actually have a really positive open rate, reading rate, click-through rate. So thank you to every single person who does read these emails. But you can see for, what month was it? For the October edition, we allocated 67.395 million to traders in silver. And then we allocated another 7.8, here's me saying 30. 7.88 million to traders in gold. Meaning that that's what, 75 million euros last month went out in allocations to traders. Now, of course, that's all virtual allocations, right? So that's not real investor capital, but we can grow DarwinIA as Darwinex grows. Okay. And the great thing about DarwinIA now is, now that we've introduced DarwinIA Gold, or sorry, DarwinIA Hedge Zero as the investor to DarwinIA Gold traders, is we can basically hedge a lot of that exposure that we have to those virtual allocations as possible, making DarwinIA way more sustainable, meaning that we can aggressively grow DarwinIA in the future if we want to, as long as we know how much exposure we need to hedge. I won't go over the Hedge Zero account because I've spoken about it a lot recently in the past couple of sessions. But yeah, on top of this, I mean, and not to get too sidetracked, as you guys know that I do every time I start talking, that's just DarwinIA. Then we have the investor capital. Now, over the past 13 years, I say over 13 years, it's not, for the first few years, it was like it took a long time for the wheel to start moving, and then it kind of picked up. So we've raised over, I want to say about 130, 140 million when we was at our peak of investor capital in the Darwinex exchange, meaning that was roughly 130 million. Maybe I've exaggerated a little bit there. It was over 100 million. I believe it was over 120. So, and I'm sure 130 rings a bell. But again, over 100 million raised by third-party investors, by our own traders, and by Darwinex ourselves, invested through the platform into individual traders. Now we have the hedge fund. We have 8 million through Darwinex, and we also have capital coming through from the AMC certificate as well. So we've got over 8 million. That then gets leveraged out to traders. So the figure that you see here, when it gets distributed to traders, is leveraged up by 7 times. Okay, because the index is so diversified, we have to leverage the capital up, otherwise we'd make like 1% per year. So even though it looks like 8 million here, and this is really important to understand, even though this looks like 8 million here, this is actually, how much would this be? Actually be almost 56 million that's actively allocated to traders right now. Hey Tail, how we doing? Childless handsome lad. What a description of me. So that's actually 56 million that's allocated out to traders right now. So if we can grow this to 50 million, which is roughly the capacity that we want to take in for index, at least initially, before we work on expanding the capacity further, 50 million times 7 is about 350 million that would be allocated out to traders. So yes, it could be diluted. However, we are actively working on scaling this figure as aggressive as we possibly can. And as long as we fulfill our commitment to do that, then traders won't have an issue getting capital. But this is kind of a flywheel, right? Because we can only raise this capital, or let's say we could only raise this capital aggressively if traders perform. This is very much based on this. Okay, if we can't find good traders, we can't raise capital. But if we can't raise capital, we can't find good traders. That's why it's taken so long for this flywheel to pick up. Now we have 200 plus great traders in the index. We've got 8 million plus invested. Now it's just, okay, how do we keep growing this? Okay, how do we keep finding these traders? You know, we might only introduce 1 or 2 traders per week to the index, but we're trying to find the best of the best. Okay, and then they come into the index. Whilst they're performing well, obviously it grows the index track record. That then becomes more attractive to investors, and it's an easier sell. Then the more that the Darwinex brand grows, the more people hear about us organically, and it's just kind of this flywheel that is picking up pace slowly but surely. But I personally would say the growth that Darwinex has had as a company in the past year has far surpassed the previous 12 years. Okay, it is picking up speed. It's like when a snowball starts rolling and it just gets bigger and bigger and bigger and bigger and bigger. That's how I see Darwinex now. It's just this snowball that is getting bigger and bigger and bigger. I think we'll hit 10 million AUM in the index by the end of the year, and if we do, that will put us in a great standing going into 2026. Then the goal is 50 million for 2026. If we can get 50 million into the index in 2026, the issue won't be diluting capital for traders. It will be finding as many great traders as we can to allocate capital to. Both new accounts are all-time high, Tail. Fantastic, great work. I'm presuming XXBI is pretty much qualified for gold now, other than the time. Fulfillment said, makes sense. Thank you very much. Absolute pleasure, my dude. Tail, just point the investors to XAQP. Heard that ticket is not too bad. Albina said, being investable is my goal, but don't know how to go about it. Well, it's different for everybody. You've got to find a trading style that suits you. You've got to get good at what you do, meaning you've got to have an edge. You've got to have the psychology and the risk management to match it, whether you're an algorithmic trader, discretionary trader, scalper, whatever you decide to be, and then just be consistent with that over a long horizon. Build a track record, be consistent with it. Don't swing for the fences thinking that one trade is going to build your career. It can blow your career, but it won't build your career. That's really important to remember. Whereas small, steady wins over months, if not years, that's what will start to stand you in good stead for the future as a trader. XXBI just needs time, and WXBY needs about 1.5% before end of January. Let's have a look. WXBY. I always forget your second ticker. Where is it? Here we go. Yeah, so you need 20% return. Drawdown is fine. 4 return to drawdown ratio. Great recovery there. Your drawdowns all look exactly the same. I'd do a bit of analysis on your drawdown and see what causes this. I know you trade with expert advisors. I'm not sure if they do, if they martingale in or grid in. I mean, it looks that way because you've got a high win rate and very harsh and sharp recoveries. Can I figure it out from this? 26 trades per day. Doof, you're active. Yeah, longer losing trade duration over winning trade duration. Yeah, this to me looks like your martingale or grid to a degree. More maybe soft martingale than pure hard martingale, just based on how the drawdowns look and a few different metrics that I usually check for. But it looks solid. Again, January Yeah, it'll be January that you're promoted to DarwinIA Gold. So as long as you get another 1.6% before the end of November and end of December, you should be all good to go into gold. And then XXBI. I just saw as well. Is there any correlation between these two? Let's take a look. Oh yeah. So you're actually heavily correlated with two people right now. You being the one of them. So WXBY and XXBI are quite heavily correlated. It looks like it's just this recent patch of drawdown that's been correlated though. Like before that, it wasn't too bad. But this one, who's that? VIGT. Your correlation doesn't even look too bad with them. From a curve perspective, anyway. It's just they also went into drawdown when you did. So I presume that it was just trading the same assets at the same time. Yeah, you're correlated with yourself. But yeah, other than that, I mean, you're beating me in the rankings at the minute, dude. Yeah, it's because of the current months and previous 5 months return. You jammy git. 87th, where am I? 121st. Finally, you're above me. Let's wait till the end of the month, dude. Let's wait till the end of the month. See what's happening there. I actually, going back to what I was saying at the beginning of the session about how a lot of traders are long on gold, hence the index outperforming really well. What I was noticing was, I think I started this week maybe sub 100 or around about 100th in silver anyway. And then I was just getting battered on my position. Every time I refreshed my position today and yesterday, I was just dropping through the ranks, and I wasn't even trading. Like my portfolio didn't take a trade today till this afternoon, and I dropped about 30 spots in the leaderboard, or something ridiculous like that. And it's literally just because people were holding gold longs, I presume. Seems to have stopped now because obviously gold's pulled back, and I've managed to take a trade, and well, I say my portfolio has taken a trade, so I'm up on the day, which is fantastic. But yeah, it was just weird to not be trading and just dropping through the ranks. I will take a look at your guys' Darwins in a moment. 31.18%, mate. It's fantastic. Yeah, it's been a really good, a really solid few months, and I kind of waiting for that inevitable drawdown. I mean, I don't think we'll see a max drawdown past 4.33 for a while. I think it will eventually go to 9%, maybe 9.5% based on all of my tests and my Monte Carlo test simulations that I've done. This is mine, Sorrow. Sorrow in the house. How we doing, my brother? Yeah, this is my ticker, dude. This is my portfolio. Sorry, it's our boy Kieran's. I thought someone knew that. Maybe he's playing us. Whoever it is, he must be an amazing trader. I mean, I can't comment on that. I run strategies. Yeah, he knows it's mine. I thought you did. He runs strategies with max 1% risk, right? I mean, I allocate. So no, there's not 1% risk per trade. Or 1% risk per strategy. The way I work it out is I will work out the future position sizing based on the strategy having a 1% max drawdown in all of my testing. So that's how I work out the trade size for the strategy. Okay, so if I'm looking at, I don't know, let's put it up so I can explain. Let's look at two systems. Let's compare. Let's compare two that have got a big difference. Okay, let's take a look at these. So I've got a mean inversion system on New Zealand dollar and a fractal breakout system on gold. Okay, so they're both running with a very, very similar max historical drawdown. However, you can see that New Zealand dollar probably has a larger percentage risk per trade because it's made a larger total return. But what I want to emphasize here is the intraday volatility and the sizing of the different strategies might be completely different. For example, on the New Zealand dollar system, I might lose $150 per trade and gain $300 per trade. On the gold fractal system, I might lose $50 on a trade and only make $100. So the payoff and the risk on each individual trade is so different per strategy, but they all accumulate in their own right to a max historical drawdown of 1%. Yeah, I mean, I'm nowhere near 1% per trade. That's what, $1,000 on zero, and I'm losing. I mean, I show you my MetaTrader. You see $58, $26, minus 4, 94, 98, 13, 49. So I'm trading such small size, hence why I have such a low value at risk. Let's get rid of that. I lost track where we're going anyway. This always happens, especially when I start talking about XAQP. I just get lost in my in my own lane. But yeah, where was we? Yeah, I was talking about the drawdown, right? I was saying that there's kind of an inevitable drawdown coming, I believe. Like I said, I don't think it will exceed 4.33 for a while, maybe 4 or 5. The max is looking roughly about 9.5%. But I know as soon as that gets past 4, 5, 6, the run starts to get a little bit harder. I'll be lower on the rankings due to my drawdown being higher. And yeah, I'm trying to milk it for as much as I can before that as possible. And then I'm excited to get the second DarwinIA bonus point in April next year or March next year, whenever it ticks in. I don't know if it ticks in it'll be for April, won't it? So yeah, it's just seeing this as a long-term game. I mean, Saro is a perfect example of this, right? Is PVWV. He's just coming in. I remember when Saro started building his record, and he stayed silent about it. I remember him sharing it, saying he was building his track record with Darwinex, but I'm not going to share it. And then I believe you started sharing it somewhere around here. You built it for a few months first, and I actually use Saro as an example when I'm talking to anybody. As you can imagine, I speak to, well done as well, Saro, 18th out of 475 on gold. Absolute bang on. As you can imagine, I speak to a lot of influencers, right? And people who have large followings who are looking to build a record on Darwinex. And my piece of advice to them is always the same thing. And I always say you should follow Saro Trades as a blueprint, is do not share your record until you start picking up steam. As in, like, not to be hiding anything or not to be non-transparent, but until you've given yourself a buffer, the pressure's on, right? Because if you're starting at zero, like when your record starts, let's say you go on a max drawdown and you just instantly start losing money, visually to people who are watching you, because there are people out there who want you to fail, without a doubt. All of a sudden, you put this additional pressure on yourself. You might start with, let's say Saro's max drawdown is 8.82%. Let's say he's done that right off the bat, gone into 8 or 9% drawdown. What do you think people who are waiting for the fall down of that influencer or that person are going to start saying at that point? Then what happens is it starts getting into your head and you start taking stupid trades or mismanaging the trades that you do take, and it spirals and it spirals and it spirals. And I've seen it hundreds of times where an influencer will, and when I say influencer, I don't necessarily mean somebody of influence. I just mean somebody with a large following. Two completely different things, and never, ever, ever get them confused with one another. When I'm speaking to somebody with a large following, I just always say, do not put the additional pressure on yourself from day one, because as we know it, 99% of traders cannot trade, right? And aren't profitable long term. Maybe not 99%. Maybe I'm being a bit finicky there, but let's say 70, 80, 90% of traders cannot trade, categorically cannot trade. So I would say, prove to yourself first before you start trying to prove it to other people. Because if your only experience is trading with funding companies or funding companies masquerading as prop firms, if that's your only experience as a trader and you've been doing this for a couple of years, you are in for a rude awakening when you cannot no longer reset your account or hide behind a payout certificate. Okay, like as if payout certificates are some form of certification that you can trade. You might have spent 400 grand on challenges and then made a 10 grand payout, but if you post a 10 grand certificate, people aren't going to know the true story, right? And you can't hide from that when you're building a record. It doesn't even have to be through Darwinex. It can be an account connected to my FX book through a regulated broker, or connected to Kimfo, something where your performance is audited by a third party. You can't just hit that reset button. And if people are watching you, the pressure becomes immense. I've seen influencer, and again, person with a large following, influencer after influencer after influencer fall like dominoes as soon as that pressure starts to rack up. So I always say, going back to my initial point, because I'm rambling again, is don't share your performance from day one. People get really excited when they hit that first trade, and then their equity chart starts to look green and they start sharing. And I'm always like, oh guys, such a tricky road to navigate, because people start watching and people don't forget. How are we doing, BT Capital? Hope you're all good. And so one thing about people is, again, influencers will post something and then 2 weeks later they might post something completely different, or they'll start changing something or what have you. And they don't realize that people remember what you say. As soon as you've typed something or recorded a video, it's out there. People have watched it and absorbed it. And I won't name names. There's been far too many to even think about. The people who change their story consistently, time after time, and get called out for it because they just forget that they've actually put specific, words out there or content out there, and they forget that people actually watch them. Sarah said it was hard. It was even hard for me as I had a live my FX book also. There was a lot of pressure there. Most can't handle it, really. Yeah, and I mean, I take my hat off to anybody, including you, Sarah, who does. It's a lot easier for me, right? Because my portfolio is fully automated. It's a multi-strat, so I kind of don't mind. It's very like hands off, and it is what it is. Whereas as a discretionary trader, like you have to press that button, and you have to decide whether to take the trade, regardless of whether it's a good day, bad day, or flat day. Like you have to make that decision, and that's where that becomes so much more difficult. Especially when it's all public, and the worst thing is, like, you no longer have just a public record. You've also got over 500,000 under management. So there's then that additional pressure from knowing that you're managing capital for other people. So not only is it like a visual thing where people have seen your record and they're going, oh, wow, Sorrow's doing great. Like, how long is he keeping this up for? What have you? You've also got investors who have gone, I trust this guy with my money. And that's pressure that you can't explain to somebody how it feels until they've experienced it for themselves. And like I say, quite often people throw themselves into the lion's den, as the saying goes, way before they should. There's a reason why there's a lot of great traders who don't share much and just sit on the sidelines and commentate from the safety of their own bubble, because they can't perform with the pressure, even though they can trade. But anyway, yeah, bit of appreciation for Saro, about to hit 40% return, max DD of 8.8%, number 18 out of gold. It's difficult to kind of say, I think, like gold and silver, because there's different amounts of traders in each one. It's difficult to say like I don't know how you're performing overall. So the best way to say it is like you're 18th out of 10,600 traders right now, because you've got the gold, the calibration, and the silver guys. You might have had some guys in silver who've had a great few months, and therefore they would be ranked higher than you in the silver rating. However, they haven't got to gold because they haven't done what you've done. So you're technically 18th out of almost 11,000 traders. So absolutely phenomenal stuff. Max DD in the past 6 months has been around 2.5%. Yeah, it's a shame that you can't see that, isn't it? When you've gone into gold, I'm presuming that's this part here was the biggest drawdown, and now that's kind of gone out of the past 6 months. I mean, I'm not sure if you changed anything, because like I would say this period of performance looks significantly different to here. I don't know whether, and we see this a lot or at least I see it a lot when I'm going through people. Has made some changes. Yeah, you can. So Missy's calling me. She knows I stream at this time every day. I swear, your missus just don't listen to what you say. I see this quite often with people, right? Is they start building a record, they start trading with Darwinex, and then they see things going well. So this period, you go, do you know what? Actually, doing better than I thought. Doing better than I thought I would. Oh God, what do I do now? There we go. And people take themselves by surprise. And let's say you get into here and you start going, do you know what? I need to take this a bit more serious. I'm going to put some things in place to avoid, these steeper drawdowns, to avoid the volatility. I'm going to trade it a little bit more serious. And so we do see this a lot where you have this kind of like more volatile period of the record, and then it starts to smooth out into something more like this. Now, I can tell you categorically, even though the performance might have been better from a percentage-wise or percentage perspective here, an investor would much rather this, would much rather that stable gain with low drawdowns, consistent performance month on month, as opposed to sitting through here what looks like 3 or 4 months of, slow growth, bit of stagnation more than anything, and then an explosive couple of months where they've made 20%. An investor would rather have 2, 3, 4% per month consistently, and something a little bit more like this. Now, of course, that's a dream. Not everybody is going to get that. Not everybody is going to be able to provide that. Of course, I'm not stupid saying, you just keep your curve like this forever and you'll be golden. Of course, you're going to have worse periods, but this is what you should be aiming for, not massive trades and massive periods of volatility. Again, going back to what I was talking about earlier, is the not swinging for the fence on any trade and realizing that you just need to be more consistent and you just need to keep doing the same thing day in, day out. Right side above, instead of all, choose 6 months and show the statistics below. Yeah, like that. That's it. That's the curve I like. You exploded with capital as well. You went from 20K, 50K, 60, 70 for a few weeks, and then just boom, straight up to 250. And now you're almost just under 500K of invested capital. Like phenomenal work in a year. I don't think people appreciate this, right? I don't think people appreciate how difficult that is to get investors to trust you when you've never met them and have them allocate like size to your strategy. 2 seconds. Sorry about that. Mrs. kept calling me, so I just had to tell her. But yeah, people like, it's so difficult to get investors in the real world anyway, and to do that without meeting them or shaking their hand or promising them the world is phenomenal. So congrats to you, Sarah. Please give me a feedback on Darwin KFEA. Let's load it up. I won't be able to do a full Darwin breakdown because that usually takes me an hour, and I've got 15 minutes, 10 minutes, 15 minutes. But we'll take a quick look. Hey man, any chance of interviewing Juan Calan in the near future? I'm interested in Darwinex future and your overall plans. Well, you couldn't have asked that at a better time, because Juan is flying over on Thursday this week and I'm traveling down to London to record the first episode of our podcast, which named TBD, but we're thinking fly on the fund wall. And the idea of the podcast is to be a behind the scenes, what really goes on in the background of this industry. So interviewing key leaders in the space, whether it be market makers, owners of brokerages, capital raisers, institutional traders, all of these different people, to talk about topics that nobody else talks about. There's 1,000,001 trader interviews out there, and to be completely honest, I'm sick of doing them myself. I like speaking to traders, but I like speaking to traders because I'm interested. But recording another interview and putting it out there, it's kind of like, what are we doing different? Like there's nothing being done different. You know, like you could go on any podcast in the trading space on YouTube and you could listen to somebody talk about their strategy and talk about X, Y, Z. However, nobody is talking about what goes on behind the scenes. Everybody's looking for the golden bullet. Okay, how do I trade? What do I need to do? What does that guy do who's made $1 million or whatever it may be? But nobody's asking the questions. Okay, when I get there, how do I raise capital? How do I get the regulatory side covered? You know, how does a market actually work from a market maker perspective? Not some idiot online saying the market makers are after your stops because that's what they do. Nothing like that. Somebody who's actually done it, who goes, actually, I don't even know where my own stop is, let alone a retail trader with $1,000 in their account. That's the idea and the notion behind the podcast. So yeah, that's what we're recording that on Thursday. I'm also recording an episode with another guest on Thursday for the podcast, which is going to be really good, who is an ex-market maker, or at least has market making experience, and was an institutional trader for a long period of time. Started out as a runner, worked his way up, and then ended up, I think he was the largest crude oil and nat gas trader in the UK or in the world or something. And then went into market making for, God, I'm probably butchering his experience here, for the Henry Hub natural gas contracts, I believe, and maybe Brent. I'm not sure. He might be watching this, and he might give me a slap on Thursday for butchering what I've said, but it is what it is. That's the idea behind the podcast, anyway. So yeah, we're recording that on Thursday this week, and it will probably come out in the new year. I'll be honest with you, it'll probably take some time. Reason being is, we want to do this thing right, because this podcast has huge potential, because like I say, nobody's having these conversations publicly. It's going to be really good content, and we want to get it edited properly. Hence why we're doing them all in person. I don't want to do any more online interviews, or like I will with traders, but I don't want to do this specific podcast online. It needs to be in person, needs to be high quality. Everything needs to be done right. And our graphic designer has gone off on maternity leave because she's heavily pregnant. So sending love to her, but because she's no longer here to help us temporarily, we're going to have to get external graphic designers, video editors in, so that we can get this stuff edited to the quality that we want it to be. Whew. Okay, my kids are going to be back in 5 minutes, so let's try and blast through KFEA. Looks great. The only thing that concerns me at the moment is these sharp drawdowns. What I would be doing here is taking a look at your drawdown analysis. So taking a look at these 14% drawdowns. Okay, like 14%, that's quite a weird number to bounce back on, and it's quite sharp because they last 20 days, 32, and 12. So it's not like an extended period of drawdown. It's not like you've sat in drawdown for a year. That's a very quick drawdown. Again, signs of martingale grid trading, but I could be completely off the mark there. It's just one of the signs I look for in somebody who martingales. I would analyze the trades that you took within these date ranges and try and understand, well, what happened within that. Why did you go into such sharp drawdown? I won't be able to take a look at HZBO today, unfortunately. I will be able to take a look at it tomorrow at 4 p.m. UK time. I'll be streaming tomorrow, just because I've only got a few minutes before we need to call it an end to the stream, because my kids are going to be home in a moment, and I'm heading out for an hour or so. Okay, so that's my first concern. The great thing is you haven't been in one of those drawdowns in the past like 6 or 7 months, which is fantastic. But I would still go back and analyze what happened during these periods of time, because there's 1, 2, 3, 4. I would class those as separate drawdowns. There's 4 drawdowns that I'd be looking at and studying. Why did that happen? Was it strategy related, or did you do something silly? Did you start trading against your plan? Did you start oversizing? Whatever it may be. Take a look at what caused it, or the effect of what were the trades, what was the process at the time, and try and find out the root cause of the issue. If it's strategy related, well, then guess what? Maybe your strategy needs a bit of work. If it's psychology related, then you can easily diagnose that just by looking at the trades, understanding, should I have been in that trade? If no, why was I? And really start doing some self-diagnosis on those periods. Okay. And on the individual trades. What's great is you've got a two-year track record. This month will tick off your 2-year record, 15% or 16% return last year, 17% return this year. So you are doing like phenomenally well from a consistency perspective. Other than those periods of drawdown, like this is something to be proud of, okay? Because you're outperforming inflation, outperforming any rate you're going to get in your bank, and I would say on average outperforming the S&P 500. And any sort of property investments that you can make as a general rule of thumb. You can't compare it to the NASDAQ did 20% last year, or the S&P did 25% last year. You can't say 1 year. We have to look at it as an average. It's very difficult to do this, and not many people can. So that's tick number one. It's just about improvements now. You've already got the base. Again, my first improvement would be smoothing this curve. It's kind of the opposite to what we looked at with Saros, where Saros start. Oh no, it's not really. It is a little bit more volatile here, and then what we've seen is this kind of stable, steady growth, as if you've made a change, which is really, really solid to see. But what I wouldn't want to see is a 12% drawdown from here. Giving back half of this 6-month stuff and then a sharp recovery again. It's not the greatest from a visual perspective. 1,200 trades, 91.94% long exposure. So you're long 92% of the time. So presuming that you trade indices. Yeah, indices, stock and ETFs. Yeah, so, pretty much, actually that's 70, 89, pretty much 95% of your exposure is within the stock market, either through indices, or in individual stocks. So it doesn't surprise me that you have such a high long exposure. The only thing with that is, of course, and it does kind of explain these drop-offs a little bit more. The problem is how do you perform during a bear market? Generally, we're not going to find out until we have those kind of market conditions. But what you find is with stock and ETF traders anyway, or guys who are trading indices, you can still outperform on a bad year if you can sort of hedge the drawdowns, right? So if the S&P goes on a 10% drawdown, but your portfolio only goes on a 5, 6, 7% drawdown, it's still a win in my eyes, because you've still outperformed the S&P on an asset that is moving in the same direction as the S&P. 2.4 trades per day, 42% win rate, but you have a payoff ratio of 1.76 on a trade, which is fantastic. Yes, sorry, I did miss yours. The streaming is my time here though. Tomorrow, please check me out. Endpoint. I will do. Try and attend the session just so that you can remind me of your Darwin ticker, and I'll try and go through the 2 that I've missed today. And then we will be doing some more on Thursday with Edgewant guys. Well, at least I think it's Thursday. But I'll do the proper Darwin analysis tomorrow. Duration ratio, again, fantastic. This is a massive green flag to me. I'm not saying that you have to have a higher duration ratio to be a profitable trader. I'm not saying that at all. But generally, what it shows to me is that when this duration ratio is positive, or when it's high, is that the trader knows how to cut losses early and knows how to let runners win. Again, if you're trading a specific strategy, maybe just by nature of that system, it has a negative duration ratio. And, it's not great from that one figure. But when everything else is good and the duration ratio is positive, it's also a really, really positive sign. Because like I say, your average losing trade takes 12 hours and 48 minutes, whereas your average winning trade takes 2 days and 14 hours. So you're willing to sit through and hold a winning trade, which tells me a lot about the psychology of you as a trader, is you do not mind sitting in winners. You don't get overwhelmed by different emotions when you're sat in a load of profit, because a lot of people, that's the worst position to be in. They don't mind taking losers. The losers are okay. It's the winners that get them. They might see that they're up 0.5R, 1R perhaps, and they might start going, this is going to turn. I need to close out. I'm guilty of it myself, right? Like that was always my sticking point as a discretionary trader, is I couldn't run my winners long enough because I just always wanted to get out of them, right? So that's a real positive sign. Yeah, goes to show that. Your value at risk is quite unstable, which is something that I would potentially look at smoothing out if you can. At this point, when your VAR is like 97%, I'd be really, really concerned at that point, 98%. What we've seen over the past 13 years is that anything above 30% has an exponentially higher chance of blowing up the account. Again, not to say that it's guaranteed that that will happen, but there's a much, much higher chance. You're at a much better place now at 38%, although I would rather see you get underneath 30% and kind of keep it stable. Just load my pen. Let's use blue because it's most like yours. So what I would like to see is this stay steady somewhere like that now. If you can do that over the coming months, and then the bands around it should tighten as well, the more consistent that you get with that. This doesn't really change much for your Darwin because it's a self-balancing mechanism, right? So you have your VAR and you have your multiplier. So your risk multiplier, which is this down here in this corner. Okay, they self-balance themselves. Your VAR goes up, your multiplier comes down. Your VAR goes down, your multiplier comes up. However, from an investment perspective, when we're thinking about the index and we're thinking about investors who are looking at your system, they know it's much easier to look at a trader like this and know that their returns and their volatility is going to be stable moving forward. Whereas this to this to this is going to take far more management from an investor's perspective, which generally isn't what they want. They want to invest knowing that, you've got it handled. And the thing is here, if we take a look at this, that was around 15% value at risk, and this was about 98. Okay, so it's not a 15 to 100% increase. So it's not a, what would that be? 85% increase. It's not even that. 15 to 30 is a 100% increase. 30 to 60 is a 400% increase, 300% increase. My mental maths is awful. I'm not even going to attempt it. So what we're looking at here is like a 500% increase in exposure. It's not just a 15 to 98. It's like a 4, 5, maybe even a 600% increase in exposure, and then equally decrease in exposure to the downside, meaning that your stability is really difficult to manage. In fact, before we finish, if I check your Darwin on Darwinex, we'll be able to see your risk stability score. The KFEA. Yeah, you can see your risk stability scored 2.6 out of 10 because of how unstable it is from peak to trough. So that's something you've got kind of two things, in my opinion, to work on moving forward. Number one would be keeping your value at risk steadier. So trying to keep it around the 30 to 35% region consistently over time. Might mean adjusting your position sizes and keeping that, kind of similar moving forward. And then secondly, I'd be looking at how to work on your drawdowns to make sure that you don't have these big dips and recoveries again. The smoother the curve, the better. Of course, that's in an ideal world. You're never going to be able to satisfy that 100%, but I'd be looking at ways to improve it so that your curve is a lot smoother than having those big drops. Anyway, guys, I'm going to call it a session here because I think my daughter has just got home and I need to go and sort her out before I head out for the evening. It's been a pleasure as always. I will be back tomorrow streaming at 4 p.m. UK time. So for the guys who I didn't get a chance today to go through your Darwins, please come to tomorrow's sessions and I will take a look at them, do a little bit of a deep dive. Also, KFEA is a fantastic Darwin. There's some slight amendments that I think you should make and should look into. But other than that, you're doing things that not a lot of people can do. So, my hat's off to you. Kudos. Just keep up the great work and constantly look at little improvements that you can make over time. So, guys, I just want to say have a fantastic rest of your morning, afternoon, or evening, wherever you're watching this from in the world, because we have people watching this from Australia, and that's 2 a.m., 3 a.m. right now. So if that's you, go and get some sleep, wake up refreshed tomorrow, and we'll be back at 4 p.m. UK time tomorrow for tomorrow's session. Peace out, guys. Have a good rest of your day.